Good morning and welcome to the Noble Capital Markets Virtual Equity Conference. I'm Joe Gomes, Managing Director and Senior Analyst at Noble Capital. Today, I have the pleasure of introducing Fat Brands, a company for which I currently provide research coverage. Following the presentation, we'll have some time for questions and answers. Feel free to submit questions using the Submit a Question function. With us today from Fat Brands is Andy Wiederhorn, Chairman of the Board. With that, I'm going to turn it over to Andy. Andy, the floor is yours.
Hi, everyone. Thank you, Joe. Appreciate you all joining us. I'm going to flip some pages here so we can start the presentation. So Fat Brands, just some background. Fat Brands is a global restaurant franchising company. We run an asset-light business model, which means most of our restaurants are franchised. We have about 8% that are company-owned. The rest are all franchised. So significant portion of our income is royalties and franchise fees. That's what an asset-light model does for you. We grow both by acquiring additional brands and also growing the brands we own. Today, we have a significant pipeline of additional restaurants we have sold to franchisees, and I'll go into the details later. But organic growth is a big part of our growth, and it's free. We've already signed up franchisees, and we're not having to pay money to buy another brand. So it's a great strategy. We take these brands and put them onto one platform where we essentially have one back office, like one accounting department, one legal, one purchasing, things like that, different marketing departments. But there's a lot of synergies by acquiring the brands and putting them onto the Fat Brands platform. And then we get purchasing power combined here in terms of all the brands and how much we spend on food and paper and beverages. We've done this now 18 times. We have 18 brands in our portfolio. We've acquired a significant amount of management experience from the brands we've acquired and the team members we've added. So we have a very deep management team, and I'll walk you through that too. Today, there's 18 different brands in the portfolio. We're in 37 countries and 49 states and U.S. territories with more than 2,300 restaurants that are open and another 1,100 that have been signed up and paid for by franchisees to build them over the next few years. That makes us the 25th largest restaurant company in the US by unit count. There are more than 750 different franchise partners, and a little bit less than half of that number, they are multi-unit operators. So they operate anywhere from 2 to 75 units. The rest are mom and pop operators. Again, 92% of the business is franchised. We have about 200 company-owned stores. And usually we have company-owned stores through acquisition of brands, and we inherit those and usually end up refranchising many of them. 80% of our business is domestic and 20% scattered around the world in those 37 other countries. We're categorized with our business in 5 verticals. 4 of them are on this page, and I'll show you the 5th one in a second. We have our QSR brands, our fast food brands. Fazoli's, Marble Slab Ice Cream, Great American Cookie, and Pretzel Maker makes up 23% of our sales. We have our fast casual division, Round Table Pizza, Fatburger, Hot Dog on a Stick, Elevation Burger, Johnny Rockets, Buffalo's Express, Yalla, our Mediterranean brand, makes up 36.6% of our sales. Then our casual dining restaurants, those are full service, sit down, usually a separate bar type of restaurant. And that's Hurricane Grill and Wings, Ponderosa and Bonanza, the steakhouse concepts with the all-you-can-eat buffet, Buffalo's Cafe, and Native Grill and Wings as well. And then finally, our 4th food concept category is polished casual dining with Twin Peaks and Smoky Bones, which we acquired in Q4 of 2023 with the intent to convert a number of those locations into Twin Peaks. And that's in our polished casual segment. So there you have a significant bar business. Twin Peaks has 49% alcohol. Smoky Bones is in the 17 to 20% alcohol range. And it's just a different business as a sports bar concept versus casual dining, which is more just food service. And then finally, our 5th category is our manufacturing business. We make cookie dough and pretzel mix for our franchisees out of our production facility in Atlanta, Georgia. We have a 40,000-foot facility. It takes up about a half an acre on a 4-acre parcel of land near the Atlanta airport. And in doing so, this business makes about $15 million a year in EBITDA, just selling cookie dough and pretzel mix to our franchisees. And our capacity at our utilization at our factory, we're only about 40% utilized. So we have tremendous room to grow that factory business by selling more cookies and pretzel type products across our brands and doing manufacturing for third parties. And our goal ultimately will be to fill up or use up that capacity and then look for a liquidity event for the factory business. As a franchisor, we do almost everything for the franchisee except run their restaurants. We help them select their site, we design their restaurant, we set up their supply chain, we train their staff, we handle their PR, their marketing strategy, their digital media strategy, and most importantly, we coach them on their financials. It's very important. We view this business as the franchisee is the customer, and their profitability is what's critical to the success of our business and their business. If they make money, they're going to build more restaurants and pay us more royalties. If they don't make money, we know what's going to happen. So we try to coach them to know with their finger on the pulse of how they're doing every day, every week, and every month in their business by running their numbers, their labor costs, their food costs, their controllables, things that they can tell on a daily basis. We don't want a restaurant operator to wait for his accountant to give him his financial statement 3 weeks after the end of the month when he doesn't know if he's made money or not. So coaching the customer, the franchisee who pays us a royalty every week, is really critical to our business and the success of our system. In terms of our acquisition strategy, in 2021, we acquired 9 different brands, including late Q4 of 2020, the Johnny Rockets brand, and we grew significantly in our portfolio. And since then, we've made more strategic acquisitions, like the acquisition of Nestle's Toll House Cafe by Chip. That's a cookie business, which gave us both additional cookie stores that we could convert into Great American Cookies, which we've now converted, I think, all of the Nestle Toll House cafes, and also gives us more cookie dough to produce from our factory. So it was really 2 bites at the apple and very strategic. Similarly, the acquisition of Smokey Bones, which is a great barbecue brand and will be great for franchising, but also it gave us a number of locations to convert into our Twin Peaks sports bar concept. Twin Peaks has average unit volumes north of $6 million per store versus like $1.4 million for a Fatburger or $2 million for a Native Grill and Wings. And Smokey Bones is doing about $3 million in average unit volumes. But the highest and best use for some of those locations that Smokey Bones has is to convert them to a Twin Peaks where we could do between 6 and 12 million in sales, depending on the location. So we are converting a number of those units, about half of them, and then the other half will stay Smokey Bones, and we'll start franchising and growing that business as a barbecue business and backfilling in markets where we did conversions. It's a huge opportunity. And I think as we look at the current interest rate environment, inflationary environment, the number of brands for sale, we've been very selective ever since 2021 when rates started going crazy to find the right kind of strategic acquisitions. We don't have a salad brand. We don't have a sandwich brand. We don't have a coffee brand today. We don't want to be in fine dining. So we've been selective about what we would buy that makes sense in our portfolio. And we have a number of targets that we're interested in. And I think you'll see us continue down that path to make strategic acquisitions where we sort of get 2 bites at the apple here, both more this year and some next year. Just in terms of our scale here, these are Q1 highlights, obviously Q2 almost over here this coming Sunday. 4.8% growth in system-wide sales, so more units growing total sales. Q1 same-store sales declined down 4%. We've seen improvement in Q2 from that number. System-wide sales, $581.8 million in Q1, again on track to do about $2.5 billion in system-wide sales across all the brands. We opened 16 new stores in Q1 and significantly more than that in Q2. $152 million in total revenue, will be over $600 million for the year, both from the sales of food and beverage at our company-owned stores and then royalties and franchise fees in our factory business. And $18.2 million of Q1 adjusted EBITDA. 2023 full year adjusted EBITDA was around $92 million, and we should beat that this year. Here's a slide that just sort of walks you through the growth in royalties, in revenue, in adjusted EBITDA, system-wide sales, things like that. Noting that our revenues are up significantly in Q1, and that's because of the acquisition of Smokey Bones in Q4 of 2023. Our strategy for 2024 is really to keep doing what we're doing and keep our head down and grind things out here, which is to get as many of those new stores open as we can. We have a goal of hitting 125 new store openings out of that 1,100 store pipeline this year. We opened 125 last year. We want to incrementally capture more EBITDA. So that pipeline of 1,100 stores is worth about $60 million of incremental EBITDA to add on to that 92 million of adjusted EBITDA going forward. So the sooner we get those stores open, the sooner we're collecting those royalties, and also to grow our factory business. So that's a key focus right now, is fill up the factory and get new stores open. Of course, we want to maintain strong liquidity, and we hold on our balance sheet a significant block of our own securitized bonds, secured by our royalty streams. And we use those when we need to raise liquidity, if we want to make an acquisition or if we need cash just to run the business. Growing our factory, like I spoke of earlier, is very important strategically. I think there'll be an opportunity to create a liquidity event with the factory at some point in the next year or two. Also, taking advantage of our purchasing power. We have more than $600 million in purchasing power. If you have 2.5 billion in sales and you have 25% or so food costs, you have at least 600 million in purchasing power. And that gives our franchisees a real opportunity to save 2 or 3 points in their food costs by being part of the Fat Brands system versus being an independent. So we think that's a great benefit of being a Fat Brands franchisee. And then finally, we want to continue to build value and the opportunity for future liquidity events and essentially debt reduction as well. And so, as we've told the market before, we announced a year ago that we plan to take our Twin Peaks brand public sometime this year. And we announced about a month ago that we were confidentially on file with the SEC with a registration statement. We hope to conclude the SEC review process over the summer. Never know exactly what the timing will be, but subject to market conditions, we hope to see Twin Peaks as a public company at the end of the summer. We have a very deep management team and board of directors. I'll walk you through both. We have 2 co-chief executive officers, Ken Kuick, who has experience both as the controller from Caesars and VC Properties, and then CFO at Noodles & Company, Rob Rosen, who was a portfolio manager at Black Diamond Capital Management, the private equity firm, and before that, Kidder Peabody and Fleet. And then we have a chief operating officer, my son Thayer, chief development officer, head of franchise sales, my son Taylor, our chief brand officer, that's my son Mason, who handles all the branding and marketing campaigns for our different brands and the development of new restaurants, in-house legal counsel, chief marketing officer for strategy across our brands, and then our brand presidents, Joe Hummel at Twin Peaks, Jake Berchtold for all the fast casual brands, Allison Lowenstein for our QSR division brands, Greg Nettleton, our casual dining, and David Pear for Round Table Pizza. And then our finance team, our concept team, our IT team. We have a very strong senior management team here. A number of these individuals joined FAT by way of the acquisition of brands that we made. And so it's been an opportunity to retain talent. We have a large board of directors made up of 7 independent directors, 7 management directors. We'll actually flip to a majority of independent directors in just a few months when one of our directors becomes technically independent. And we have, even though we are a controlled company under the NASDAQ rules and have elected control company status, we of course maintain an independent audit committee made up of 6 or 7 of the independent directors, and then also a compensation committee as suggested by NASDAQ. The only thing we don't have is a nominating committee, as we already have such a large board and it's not required. In summary here, again, it's an asset-light business model for a global restaurant franchising company. We have strong organic growth. We're going to grow our franchise units by 50% over the coming years, another 1,100 stores to come online on top of the 2,300 we own today. And there's an opportunity there just to reap the synergies and eliminate duplicative overhead, having one accounting department, one legal, one finance department, one purchasing department, things like that. We've made a number of acquisitions as we started 20 years ago with just the Fatburger brand, and now we have 18 different brands. So we have a history of acquiring these brands and integrating them. And as I just went through with you, a very deep and strong experienced management team. So I'm happy to walk you through. This presentation is on our website at fatbrands.com and under the investor section. And I'm happy to answer questions now and see what also might make sense for everyone.
Thanks, Andy. Excellent presentation. Very informative. Appreciate it. So I'll start off the Q&A and then mix in some from the audience. Now, obviously, there's been some big news here, with the SEC. Can you provide any update as to the timing of a potential resolution with the SEC for the company?
Yeah, we are fighting rigorously the SEC's claims regarding disclosure, and I don't think that gets resolved anytime soon. We can't really comment too much on the legal stuff, but I would envision this being a 2025 or 2026 resolution. It's not going to be this year.
Okay. Okay. Let's turn our focus here a little bit onto the business itself. There's been an increase in the minimum wage in California for restaurants. It's had a negative impact on a number of the operators in the state. You've seen some bankruptcies, some closings. How are the FAT franchisees dealing with this, and how are you helping them to deal with this issue?
Yeah, I mean, look, someone's got to pay for it. When you raise wages by 20 or 25%, that's going to have a direct cost to the consumer, because there's no way the restaurant operator can afford that. And the restaurant operators that have taken price, they'll suffer in traffic, but they'll maintain a margin to stay in business. The guys that didn't take price get crushed. And we've seen that in brands that we've looked at. As an example, we saw the Tijuana Flats brand in the greater Florida area not take price for 2 years, and their margin went from $10 million of EBITDA to zero by not taking price. You have to coach your franchisees on taking price, even if it costs them traffic. And then you have to coach them on giving value to the customer so that they remain loyal and they come back. So you can adjust your price, your portion sizes, your menu mix to try to manage around it. But it's just a lot of strategy to do that, not sit by idly. And so we're all over, not just our California franchisees, but this is a nationwide problem. This minimum wage creep or leap that was legislated in is going to hit 6 or 7 other states in the next 12 months. And that's going to be the same problem there. So it's very important that operators understand their margin and understand where they have cushion.
Great. Now, you recently held your franchisee conference in Vegas. Want to maybe give us a little color on how did that go? Are you seeing additional interest in franchises from the franchisees, and how did all that end up playing out?
Yeah, we had about 2,000 attendees at our Fat Brands 2024 restaurant summit and franchise summit in Las Vegas, and we also sold over 100 new franchises at that summit to franchisees, and probably we're about 200 new stores sold year to date. And the significance there is that a sign of a healthy franchise system is when your existing franchisees are buying more restaurants or signing up to develop more stores. So that was a key indicator to me. The franchisees feel healthy. I'm sure rates are up. Financing is a little bit trickier. Costs in terms of inflation to build are higher, but they're still building stores. There's still profitability, and there's significant interest by the franchisees. We went over as much as we could, best practices, coach them into value, coach them into supply chain management, techniques, and taking advantage of our purchasing power. So that was significant as well. But it was a really good event, well attended by our franchisees, their managers, things like that.
Now you touched on it a little bit on the Twin Peaks and coming public. I don't know if they give us any more color. I think you said sometime, hopefully in the summer. Where are you in the process? Any other additional details there is appreciated.
We're just now addressing the refinancing of the Twin Peaks debt. So each of our securitization silos are separate debt instruments, non-recourse to Fat Brands, but recourse to the individual brands or cluster of brands. And we have 5 of those securitization vehicles today. And Twin Peaks has an amortization date that starts in Q1 of next year. So ahead of raising equity, we wanted to refinance the debt so investors are not staring down a quasi-maturity date, amortization date, and being asked to write an equity check. And so we're in the middle of that debt refinance process now with our bondholder constituents. And those bondholders are generally in all of our brands across the portfolio. They're in every one of the silos, not just the Twin Peaks silo, but they understand the importance of getting the debt refinanced so that there isn't an amortization headache going forward. Jeffries is leading that charge on the debt side. They did the debt originations originally, and happy to have them representing us again there. And so being on file with the SEC confidentially since early May, we will announce, of course, when we flip that filing public, and that'll be a sign that we're close to the end and we think that we'll be cleared by the SEC to do the listing. And you know, these things take a while, but we're way far along. And now it's a function of, you know, how many rounds of comments and you know, things we go through with the SEC. But knock on wood, it could be the end of the summer if the market, and also if the market conditions are there.
Right. Okay. Thank you for that. And on the Smoky Bones, you know, a couple of kind of related questions here. All those units were company owned. You're talking about converting a certain percentage of them to Twin Peaks. Maybe give us some detail on, you know, what kind of is the timing of the conversions? How long do the conversions take? Once they are converted, are you planning on retaining company ownership, or would you look to refranchise those locations? And then when do you think you'll start to try and grow the Smoky Bones franchise again?
Great questions. So Smoky Bones is just now completing their franchise disclosure documents so they can begin franchising. So that's coming soon. We think about half of the Smoky Bones locations will convert. The first one will open Lakeland, Florida in August of this year. So we'll have 2 or 3 that we get done before the end of the year, a number of them next year, and the balance of them in 2026. That will provide significant growth to Twin Peaks. Twin Peaks has 110 additional franchises sold. There's 113 Twin Peaks open today. We bought it, there were 83. So we'll be at close to 125 Twin Peaks by the end of the year. And that's some 40% growth since the time we acquired the brand 3 years ago. So really remarkable. But we have the locations that we own and control today for the next 3 years of growth within the Smoky Bones portfolio. And then franchisees have, you know, some locations they've picked out already ahead of our Smoky Bones acquisition. So we'll see some very steady conversion rates of these stores. 75% of Twin Peaks existing stores, 113 I mentioned, are already second generation restaurant locations. So 2 things about a second generation restaurant. The conversion costs maybe $4 million today instead of $5.5 million for a new restaurant, excluding real estate. Real estate's another couple $1 million. And then the time to do a conversion is about 9 months instead of 2.5 years to do a ground up build. So it really helps us accelerate the development of incremental Twin Peaks locations, and it's you know, economically efficient.
Okay, now you mentioned about, you know, looking for additional growth and everything, and I'll call it a quasi competitor of Twin Peaks, Hooters. We saw recently they announced that they are closing a number of their stores. Is that something that would be of interest to you and or Twin Peaks, maybe even just for the locations, the real estate?
So I think they blame those closures on their competition. Don't know who that is, but you can imagine who it might be. We've looked at the Hooters business. In most cases, we already have a Twin Peaks nearby, and so there's not a lot of opportunity in the closed Hooters locations, given that, and there's a lot of capex and deferred maintenance in those locations. So it's unlikely that this would be a conversion play like Smoky Bones would be for us. And you know, I think that they have to right size their business and deal with the realities of that. It's really an opportunity for us as the managers become available, waitresses become available, customers, you know, want consistency, and will maybe walk across the street and try out a Twin Peaks if they were a loyal Hooters customer. So I think that's the bigger opportunity, is to capture business there than it is for location conversions in the U.S.
Okay, and just speaking of the M&A environment more broadly, is there anything interesting that you're currently looking at? I mean, how do valuations look today compared to where they were previously?
So what's interesting, you know, if you think about the last 12 months, I think the investment banking community would say that number of sellers just haven't gotten a dose of reality yet in terms of what valuations have come down to, given the cost of capital in terms of high interest rates and inflation. the guys that want to get deals done are getting deals done. They're realistic. They will signal to you as a buyer that, you know, we need to clear this. Let's figure out how to do it. And they're creative. The guys that are unrealistic are going to own some of these brands for another 3 to 5 years because they're just not, you know, the buyers aren't going to step up and pay. If there's growth, people will pay for growth. If there's profitability and there's wind at your back, that's great. People will pay for that. We will pay for that. We're not looking for big turnaround plays. Turnarounds take a lot of time. They're a distraction. It's an expensive environment today, obviously with capital. So, you know, I think we're focused on opportunities to get synergies, complementary, 2 bites at the apple kind of thing, where you get some growth, you get some synergies, maybe you get some other ancillary business that makes sense. You know, but there's definitely a lot of stuff transacting. Unfortunately, a lot of it's distressed.
Okay. Running up against the clock here, but I got another question from the audience and relates to dividends. And they're wondering, why, basically, what's the kind of your thoughts on dividends, the dividend policy? Why are we paying dividends?
Well, we have a consistent dividend policy. It's been in place for a number of years. It's important to our shareholders. We pay a preferred dividend on our FAT BP stock, which is an 8.25% dividend. It's roughly an 11-12% yield today. Our common dividend, you know, if you think about our interest expense, is about $100 million a year. With our securitization portfolio, the dividends are around $8 million. There's sort of a rounding error in the greater scheme of things, but important to our shareholders. We're going to continue to pay dividends. It's tax efficient for everyone. And, you know, there'll be some opportunities with the Twin Peaks offering for additional dividends. So stay tuned for that.
Great. Well, that's all the time we have today, Andy. Really appreciate you taking the time. Great presentation. Looking forward to seeing how the future of Fat Brands unfolds going forward. Thanks again.
Thanks for having us.